What is a student loan and how do they differ from other loans? Well, for starters, a student loan is designed to pay for post-secondary education and associated expenses. You have the option of borrowing from the federal government, state government, or your college on top of the traditional lender like a bank or credit union, which offer private loans. Federal loans are often distinguished as the best choice because certain types have relatively low fixed interest rates and more leniencies. State and college loans can be the next best option, but because every state and college has their own student aid program, you'll have to do research to see what they offer. A benefit of private lenders is that you can often borrow larger amounts than you can from federal, state, or college loan programs, but the trade-off is that your interest rate will likely be higher and with fewer leniencies. Generally, students are recommended to apply for loans in order of federal, state, and college, then private. Students are expected to borrow as little as possible to cover the cost of attendance, which includes tuition, books, and living expenses in order to have minimal debt. Because college is an expensive endeavor, it can lead to a need for larger loans. You should be wary of how much you borrow because it can take a long time to repay them, which in turn can hinder your lifestyle in the future. Many people view student loans as an investment in your education because you borrow money now and pay it off later with the hope that education will lead to higher income and ultimately a better life. The best way to minimize your dependency on student loans is to apply for financial aid, scholarships and grants, and then to pay as much as you can afford out of pocket prior to applying for loans. Although those may entail more work on your part and may necessitate a change in lifestyle, the amount of money you can save could be significant. When leaving college and entering the workforce, the less debt, the better.